Your ability to build wealth is influenced by both art and science. The art has to do with your ability to deploy a body of knowledge that enables you to command attention, pique interest, arouse desire, move a specific audience into action, make impact, and build confidence, trust, and credibility. The science has to do with your ability to achieve the high reward, the measurable results, the predictable outcome with the highest degree of accuracy. It will take me some time to decode this body of knowledge, but let me get to the point. Today, I will be sharing with you 5 steps that you can take to build wealth and perhaps build wealth fast. And the very first concept that I want you to consider is land acquisition. Yes, your ability to acquire land can set you up for with a solid foundation for your wealth building journey. And let me say why. You see, land has tremendous wealth creation potential. There are some folks that invest in land as land banking. Now, what does that land banking has to do with wealth creation? Now, let me share this with you. There are many people that you buy land and you buy land below market value. So what happens immediately? You're buying land with equity. So if you decide to cash out immediately from that land, you have equity leverage. So for example, you may buy a land at 25,000 US dollars, but the real value is 45,000 USD. So if you are to exit that deal immediately after purchase, you're walking away with a profit margin of 20,000 USD. And that can happen in a very short period of time. But I want you to explore this from a different perspective as we go deeper into pathways to build wealth. Step 2, what if you take the land and you learn a process of how to make the land become now income producing assets? So on the land, you now fill out what is known as an income producing asset. Now, an income producing asset can represent many different portfolios. For example, you might be able to put a car park on that land because of the fact that you're charging a fee for every car that parks on the land because you're at a strategic location. That becomes income producing asset. The next possibility is you might be able to build, a wash mart or a washing mall or a supermarket on that land. And because of the fact that you have land plus the supermarket or plus the laundry mart, these things are generating income. So they become income producing asset. You can also take that land and you can build multiple family units, or you can build units that is designed to give you daily, weekly, monthly cash flow. That definitely, those are all income producing assets. Now, I want to share something here with you as we talk about taking land and upgrading land into income producing asset. Now, there are several things that are taking place here. The land combined with the income producing asset gives you a concept that we call force appreciation. And force appreciation takes place when you take things from their natural state and you add value to them. In most cases, let us suppose that the land now value 25,000 USD, and you take an additional, let us say, 200,000 USD to develop that land into income producing asset, the value of that estate is going to be much more than 225,000 USD because of forced appreciation. Something else happens here where you also have natural appreciation. So when you build and you hold that estate for a period of time, natural appreciation takes place. And natural appreciation can see the estate becoming 25% more valuable, 50% more valuable, or 100% more valuable. What do I mean by this? Let us say 5 years ago, the estate was valued at 275,000 USD. 5 years later, that value can become 350. It can become 400,000. It can become 500,000 because of natural appreciation. And as time progresses, I'm going to go deeper into all of this for you. But it is quite possible to leverage these ideas and position yourself on the wealth building journey. But I want to do a disclaimer here also. Any decision or any steps that you're going to be taking to invest capital to build wealth, you want to do proper analysis. You want to do the risk analysis. All right. And one of the analysis that you want to do is to look into the concept that we call the PITI, principal and interest, tax and insurance. Now, in most cases, you're going to be taking a debt to invest into building this income producing asset. So whether you're building a car park, a laundry mart or a supermarket or, a family unit, all right, you most likely will be taking a debt. And that debt will be subject to PITI, principal and interest, tax and insurance. One of the analysis that you want to do is to ensure that the income producing asset is cash flowing above the PITI, principal and interest, tax and insurance. These are all analysis that you would need to do. You would need to know this before you actually start the project. So there's a concept that we call the stress test. You need to stress test the market. And there are many talking points that you need to recognize in the stress test of the market. For example, you would need to look at things like who is the ideal client? What are their specific needs? Are they easily accessible? Do they have the ability to pay? Do they have the willingness to pay? And are you in a position of strength to get them to pay? You see, taking steps to build wealth is not an emotional decision. It's a business decision. And that business decision should be guided by scientific data. And that's what we do at Global Capital Inc. That's what we do at Vision Valley Business Chambers. We ensure that you have solid information to make a highly informed and educated decision when you're making a business decision or an investment decision. So we look so far at land acquisition, and we look at taking step 2, which is taking the land and up-leveling land into income producing asset. The third step that I want to share with you today is understanding capital markets. Now, why is it so important to understand capital markets? Well, all capital are not the same. Capital are not equals. And the more you understand about capital market, it's going to help you to make better, smarter, wiser decisions that can save you hundreds of thousands, millions of dollars, and perhaps billions of dollars over the life cycle of your investment portfolios. So understanding capital markets can help you to make smart decisions. Now, the understanding of capital market means that you understand capital markets from 4 different standpoints. One is the capital portfolios that exist. Now, you have debt, you have equity, you have credit, you have creative financing, you have hard money lending, but you also have group economics. And the understanding of all of these portfolios is vital. Why? Because there are many persons that will be saying to acquire land is capital intensive. To build income producing asset is intensive, but you're right. But guess what? The only reason it's going to be difficult for you to rise to the occasion is because you don't fully understand capital markets and how it works. They're always an option. And what you need to do is to understand those options that will enable you to access the capital, to leverage it into land acquisition, and to leverage it into income producing assets. So the first portfolio that you want to understand is the menu of financial instruments that exist. Second is how to access those capitals. Now, the issue of capital market exists is going to vary from country to country. In the developed world, like the United States of America, like the UK, like Canada, they have a menu of financial instruments. You're going to find debt, and debt operates different from equity. You will find equity. Equity operates different from credit. You will find credit. Credit operates different from hard money lending, and so on. So you need to understand these portfolios that exist. Understanding how they function also is important because that's what's going to help you to understand also how to access capital. In developing economies, you may have a challenge because in developing economies, you might have debt instruments and you may have credit instruments. You may have credit instruments that does not have the flexibility that may be conducive and supportive of the vision that you have to build wealth. And what do I mean by this? All credits are not equal. You see, there are credits that you can access at 0% APR for 6 months, for 12 months, or 24 months. This is not available universally. But think about this. If you're able to access 250,000 USD in credit with 0% APR for a long period of time, that's capital leverage. And you're leveraging capital, not necessarily thinking about the risk associated with borrowing, because that risk has been removed for a period of time. The risk now will lie in the portfolios that you're going to be invested in. And again, you want to do careful analysis, and making a business decision is not an emotional decision. You want to make a decision that is driven by data, by the science, because the science gives you the high reward, the measurable results, the predictable outcome with the highest degree of accuracy. And that's the decision that you want to make, scientific decision. So understanding financial instruments is going to help you to make better, smarter, wiser decisions. So as time progresses, we're going to go deeper into each of these concepts. And with Global Capital Inc. and at Vision Valley Business Chambers, we're here to give businesses universally this type of support. Wherever we are at, we're going to give you this type of support. So in understanding capital market is not only to understand the portfolio, it's not only to understand how to access. That's a deep subject matter for us to get into because there are different pre-qualifications to access. And you need to know it. But as time progresses, I will teach you this. So when you come into a master program, I will go deeper into this body of knowledge to help you to get this message. Now that you understand a little bit more about portfolios, capital market portfolios, capital market access, I want to talk about two more concepts: capital market leverage and capital market mitigation. One of the things that happens is that sometimes you access the capital But the way you leverage the capital, you leverage it in all the wrong ways. Instead of you leveraging capital as an asset, you leverage capital as a liability. And you want to be smart about this as you think about wealth creation. And let me give a typical example. You see, the average person going to buy your first home, you're excited. And in your view, it's an asset. Was it, is it really an asset? Now, an asset, let's think about what an asset does. An asset adds value to you. It doesn't necessarily take monies away from you. So when you take capital and you leverage capital to buy your first home, it's not an asset. It's a liability. And let me share with you why. Now, when you buy that piece of estate, your ability to pay for that real estate or to reach your monthly debt obligation consistently over a life cycle of 10, 15, 20, or 30 years, US is now talking about a 50-year life cycle. Your ability to honor that debt will largely depend on your income earning ability. Think about this. So if you lost your primary source of income or your source of income, what happens with your ability to reach your monthly debt obligation of paying above the PITI, the principal and interest, the tax and insurance? What happens there? Very often you cannot reach that debt obligation. And that is why we have so much of foreclosure that is taking place across the world. You made an emotional decision, but I'm talking business and I'm talking wealth creation. You need to understand this, how to leverage capital as an asset and not a liability. So when you take capital, you want to know that you're leveraging capital as a means of generating more capital to pay above the PITI, to put monies in your pocket, and to have an invest money smartly. So you must take the time to understand the smartest ways to leverage capital. So just let me give you a hint here. It would make sense, instead of buying a single unit, to buy a triplex or fourplex. And with that, it becomes an income producing asset. So immediately you're leveraging capital the smart way, the right way to build wealth. And guess what else? In this context, you don't have to go to your primary source of income because the estate is set to generate income on its own. So understanding how to leverage is important. The last concept that I'm going to talk about in capital markets is mitigation. Now, one of the things I would emphasize is that if you're taking debt, it's not enough to know the portfolios. It's not enough to know how to access. It's not enough to know how to leverage. It's equally important to know how to mitigate. Because it is in mitigation, you're able to do several things. One, you're able to reduce the life cycle of the debt. And by reducing the life cycle of the debt, you're reducing the cost of capital. And when you reduce the cost of capital, you're also freeing up the estate faster. And that means that you have more equity leverage, more chance to build wealth. I know this might be a whole lot for you to unpack. But I want to say this to you. I'm going to break all of this down when you come into our master classes to really help you to get the message. And you see, in our program, we talk a lot about listening to learn, learning to apply, applying to master, and mastering the concept to the extent that you can leverage this body of knowledge to build wealth. And that's what we want. We don't want you to learn it and just know it. You must apply it, you must master it, and you must be able to achieve a targeted end results. And that targeted end results is building wealth. That's the vision. So when you come to Vision Valley Business Chambers, You have a team of subject matter experts that is committed to working with you, to position you, to start and scale your successful businesses and to build wealth. This smart pay. Now, step 4, it's important and necessary for you to be market oriented and market sensitive. Because in the absence of being market oriented and market sensitive, opportunities will present themselves and pass you by. Well, when you're thinking about wealth, the fastest ways to build wealth, the smartest ways to build wealth, you need to be market oriented. All right. You need to be market sensitive. So you need to have a system that is allowing you to collect information, to analyze information, to leverage information the right way to build wealth. Market oriented. Market sensitive means that you are now set to be market responsive. So these 3 things must work together: market orientation, market sensitive, and market responsiveness. There's some people, yes, you're market oriented. You know what's happening. You're market sensitive. You know, if you act or don't act, what's going to happen, but then you are not market responsive. You know all of these things, but then you take no action to position yourself to build wealth. You want to master all 3. What is market orientation? What is market sensitivity? And what is market responsiveness? We will go deep into these concepts to ensure that you're a winner in business. All right. The last concept that I want to share with you today, it is by being market sensitive, it is by being market oriented, it is by being market responsive, you're now able to set the stage to increase your portfolio expansion. And because you are now expanding your investment portfolios, you are now set to significantly increase your wealth. And some things that we talk about, you see, in your attempt to build wealth and possibly build wealth fast, you have to also think about stepping out of your comfort zone. Because very often, market orientation says to you that there are wealth opportunities where you don't have the skill sets that is outside of your comfort zone. So how do you navigate these opportunities? And I can tell you that there are many times that I would sit back and I would look back at my life and I would say, hey, you know, I was just narrowly focusing on one particular way of building wealth. And they had all these other opportunities that was there for me to build wealth. And I allowed them to just pass me by because I wasn't willing to get out of my comfort zone. And getting out of your comfort zone means many things. It doesn't mean that you have to be the subject matter expert. But what if you are attracting subject matter expert, or you are a part of a body of subject matter expert like the Vision Valley Business Chambers, where you can draw from subject matter experts to start a process, to build a process that's going to make millions and perhaps billions of dollars, and you lean on their expertise and you get part of the game. So stepping out of your comfort zone means a lot, and we will go deep into these concepts to really help you to recognize these possibilities. And now let me make this a little bit more graphical. What if you are a business consultant who specialize in helping businesses to get started? And your key focus is saying to rising stars in business that if you're going to start the business, you need to identify your ideal client. You need to identify their specific needs. You need to do the stress test, because stress test works both ways. You need to act in the interest of the client and you need to act in your interest. And if you're not doing the stress test, you don't know this. And then you come to product and service innovation. You're an expert in this field. Then you talk about market viability, market accessibility, market urgency, and market immediacy. You look at the client ability to pay, the client willingness to pay. You look at how to get you're expert in these things. But let us say at this particular time, the market is reasonable or slow. But because you're market oriented, you see perhaps the state is advertising for consultants to build homes. And you say to yourself, hey, yeah, that's not my field. So Tom says to himself, that's not his field. But Matthew says to himself, well, it's not my field, but I have a supportive community of experts that are builders, that are engineers, that are private equity investors, that are experts that can take on that project. So what Matthew does, Matthew decides that, hey, he's going to bid for that project and negotiate to win that project. And he's going to bring in all these subject matter experts to execute on the project. Guess what? If it's $1 billion, Matthew walks away with 10%. That's a whole lot of money that he's walking away with without breaking a stride from his key focus as a business consultant. I'm just saying to you, sometimes you have to think outside of the box when you want to build wealth. Don't be boxed into that, that square. You want to find a way to step out of the box and explore the horizon. And that's what we're going to help you to do. At Vision Valley Business Chambers and Global Capital Inc. is to change the way you think that can position you to build wealth. So we look at 5 steps today. We talk about land acquisition. We talk about income producing asset. We talk about capital market. We talk about being market oriented, sensitive, and market responsive. And we talk about portfolio expansion. And these are my 5 steps that I'm going to share with you today on how to build wealth and perhaps the fastest ways to build wealth. My name is Gary Thompson. It has been a pleasure being with you today. And I certainly look forward to being with you in the next broadcast. Remember to like, subscribe, and share. And feel free to comment on this program. And I'll be happy to respond to you. And I want to encourage you business leaders across the world to join the Vision Valley Business Chambers, because we're here to fight for you. We're here to give you a voice. And we're definitely here to position you to build wealth. All right. Be blessed and see you in the next broadcast.